Hello and welcome to Innovation Unlocked. Today we'll be hearing from Damon Bonser. He's the CEO of British Design Fund. He'll be telling us about the red flags that he picks up on when investing in startups.
So you've got the prevalence of investors looking for solutions to climate or solutions that help us live with climate change. Right, that's one thing, and I think there's a realization now that most of those solutions require some element of hardware.
Hello, so this time I'm joined by Damon Bonser from the British Design Fund. We'll be speaking about what the British Design Fund do, but also Damon's experiences of running your own business and what you look for when you're investing in businesses and really sort of British hardware companies and investing in British hardware companies and what you look for.
Wonderful. Well, thank
Brilliant.
you for having me.
So Damon, maybe do you want to just introduce yourself briefly?
Yeah. So Damon, founder, CEO of British Design Fund. We're known for it being one of the only funds in the UK that exclusively invest into early stage hardware, engineering, technology businesses. So, technologies that require some form of manufacturing in order to take them through to market.
Amazing, thank you. And can you tell us a little bit about your history, your background?
Sure. So my career, fairly unusual. When I finished my studies, which were not anything to do with production or design or engineering, I took myself off to China and kind of taught myself how to trade and buy product and sell product. So I was kind of operating out in China, buying and selling items from factories, really, from trade shows and factories, and selling them to retailers, largely in the UK. And then took the profits from that and sort of over the next few years, reinvested them into UK, built a design team, turned that into a little bit of a design business, a product design business. And we ended up, sort of a few offices around the world, selling into retailers around the world, but it was like consumer product. But fundamentally taught me how to work my way around a factory floor. Also how to sell product, which is kind of handy in the game I do now. And it kind of kept me out of trouble for 9 years. I earned my stripes, my manufacturing stripes, I like to think. And then after selling that, came back to the UK, and that's kind of where the opportunity was just like very obvious. The fact that the UK didn't really know how to support the kind of early stage manufacturing companies, and that's where sort of British Design Fund was born, really.
Amazing. So you're now CEO of the British Design Fund. So what does that role entail?
Largely fundraising, kind of driving deal flow. So kind of being the face of the business, kind of fighting the corner for UK hardware engineering startups. Right, it's a lonely place. There's not many people like to talk to them, and even less people like to invest in them. And obviously, and supporting the portfolio. But we've got an amazing team. They do a lot of the heavy lifting. So it's kind of just, taking a bit of a helicopter view across the portfolio, looking for those inevitable fires that burst out and, sort of jumping in, gathering a team together and addressing them, and seeing those companies out of the sort of the holes that they get into inevitably as startups. But it's very varied. And obviously seeing the amazing, it's a very fortunate position I hold. I get to see all these phenomenal companies that apply to us, and sadly we can't invest in all of them, but you get to see, you sort of pond skate across all of these sectors. You're never really going too deep or you're not a vertical expert, but you can, as a sort of horizontal, I guess I'd say we have a horizontal expertise in the sense of manufacturing. But you get to, you're constantly sensing what's happening, which areas are getting hot, where there's a lot of activity. It's good. You're pond skating is how I describe it.
That's a good phrase, good expression, yeah. So you mentioned there that a lot of people are quite reticent or reluctant to invest in hardware-based businesses. Why is that? Is that because of the high capital expenditure, or?
To be honest, I think it's actually more just unfamiliarity. So if you think of VC itself, fairly new anyway, right? But if you kind of think traditionally, it's always gone into software. And you have the exits, the money flows back into that space. People set up funds that specialize in SaaS and software and tech and software tech. And the money, it kind of is a circle that, virtuous circle that keeps going round. And you have these amazing expert software founders, but the capital kind of centers around it. And then you get other investors that don't want to miss out, so they bolt on and invest alongside. And just hardware is one of those ones where the exit profiles are a bit different. They're not really headline grabbing. You don't get so many unicorns. Like when we look at our portfolio, we're not really modeling out unicorns. We're not looking at a huge failure rate and one unicorn, But the thing is, those unicorns grab the headlines, they create a huge amount of wealth for investors, and then you get these funds set up. But hardware is just it's a different model, it's a different beast. But we like it as a different risk profile, but it's one that we're very comfortable with. But it doesn't necessarily grab the headlines. It doesn't draw in those pools of capital to follow in, and so you don't get that kind of circle of capital flowing back in all the time, which you sometimes do with software. The capex side of things, and the operational expenditure and in stock and things like that, they are obviously very different to software. But I don't think that's the main reason. I think it's just that lack of capital flow and the lack of kind of comfort, and you don't get that sort of fear of missing out that you get with software. It's unusual.
And what's the kind of the general landscape been for hardware businesses in the UK over the last decade or two? Have you seen a big change? Has the profile changed? Are there more businesses now?
Yeah, so look, I wouldn't pretend to be an expert. I've only been doing this 5 years. But one thing I have noticed is with the kind of, I guess, a couple of folds. So you've got the prevalence of investors looking for solutions to climate, or solutions that help us live with climate change. Right, that's one thing, and I think there's a realization now that most of those solutions require some element of hardware. If you want to solve the problem of plastics being in our ocean, you can have a SaaS solution mapping out where all these bits of plastic are floating around and gathering, but at some point you're probably going to need some hardware to gather it up, right? So I think there's an increased recognition that hardware plays a very, very important role, and not just big established industrial players, but really agile startups have got great hardware solutions to solve these problems. So that's one part. And then I'd say the other thing of recently is probably the kind of slightly overheated software space, kind of valuations. I think just investors are they're getting a bit fatigued with that. They're constantly being pitched the same story, huge losses for a long time. Maybe not so much traction at the top. It's kind of about building up a community, and I think that model's kind of dying. So I think the two things coming together, but it's still, hardware is still, it's not always top of everyone's priority when they're looking at investment. But I'd say it's becoming less of a sort of becoming less of a sort of problem child that it used to be. Everyone would say hardware is hard. I heard that all the time when I came up with the idea for the British Design Fund. Everyone would say, "Why on earth would you do that? Hardware is hard. It's a nightmare." Now it's kind of people, they recognise it's tricky, but I think they recognise it's got a really important place to play.
And all the more important that the BDF exists, right, to help support that.
That's why.
I mean, do you think there's an element of, especially with things like AI, people jumping on the AI bandwagon, whereas, actually if it's less cool, so to say, working in hardware, actually the businesses that you do say in hardware are actually genuinely solving problems, and in some ways there's a bit more depth to them than some of the
Look, we like uncool. Like our businesses, you would not describe as sexy. They're uncool, B2B, heavily engineer-focused businesses, right? We love them. They're solving really important problems in the world, but they're often B2B. You don't see them, you don't bump into them maybe walking around in everyday sort of, they're not typically sort of consumer retail things. But I think, so I think, so we like that. But I think the kind of the profile of those founders who are typically engineering, like they come out, and I don't know, I don't want to kind of trash software founders, right? Because that's not my style. But I'd say if you were contrasting, I'd say like the typical profile of our founders, right? They are more than likely trained in engineering of some sort, mechanical engineer, gone out into industry, seen a problem, and they become, as an engineer, becomes a little bit obsessed by solving that problem. And they're not really inventing a new science. Typically, they're taking a science and they're applying it. But they're very mission driven, right? They're good, solid founders that want to make a difference in the world. And it does actually align with us as an investor, because you can only have impact. You can only solve this problem as a hardware founder by getting your piece of hardware out into the market, which ultimately means you're getting some revenue. You're not going to be giving away the thing for free. That's a big difference. You can't kind of like have a freemium sort of version typically in a hardware business. So in order for them to meet the mission that they're driven by, they have to go out and they have to generate some sales. And we're big about that. We're big about supporting on that commercial drive. It's a big part of what the support we give to the founders is get this stuff out into market. Yeah, I do. And I look across the founders and think, they're a good bunch. They're not bringing big egos. They're kind of grounded, as engineers often are, and they just want to make the world a better place.
So the BDF is more than just the money, right? It's the support and the experience of the people involved, and the mentors and all of that, right?
Yeah, look, we're hugely fortunate in the sense that a lot of our investors get involved. So a lot of our investors become advisors to our companies. That's one thing. We've got a huge ecosystem, people like yourselves, right, giving like phenomenal advice to our portfolios, completely unbiased, really. You come in and when it's you guys, you come in and you talk to them about their IP strategies and what's commercially sensible. So it's and I think we're quite, things that have helped us, I think, establish our brand in the market is, number one, we're unusual in the sense that we only do such early stage hardware technologies. But secondly, is like people know we're operators. We're not a group of kind of ex bankers that have brought in the talent to know how to operate these companies. It's the other way around. We are the operators. We don't pretend to know all the answers, but we can probably signpost you, and we know how to kind of tackle them and signpost them and get that expertise in.
Brilliant. So maybe can you tell us a bit more about the portfolio? What are the companies you've invested in, and what do you typically look for when you're going to invest in a company?
Yeah, so we're pretty sector agnostic. There's a few we don't touch, but broadly we cover quite a broad range of sectors. We do have clusters. You can see if you look at the portfolio, there's fairly obvious clusters. There's things like medical devices we do very well with. We talked about climate, things that address the climate, help us live alongside climate change, but also some that actually help us try and reverse the impact. We have those kind of things, and we have a lot of monitoring devices, a lot of monitoring businesses, so sensor businesses. And again, if you think about it, it's kind of quite logical. Like, all of these sort of data plays, they need to get their data from somewhere, and it often comes from hardware. Yeah, so river monitoring and ocean monitoring, lots of those sort of things we see. So our criteria, if there's people out there wondering about whether they should apply to the BDF, I'd say you've got to be TRL 5, so that typically means you're at prototype stage. You've developed a demonstrable prototype that you can show to a potential client. That's like a big thing. Obviously, the technology that you've developed should require some form of manufacturing to take it to market. It's a kind of no-brainer. That's the hardware piece. So you should be able to kick it or drop it on your foot, is what I sometimes say. There should be some IP coming through in the form of a patent. It's very unlikely to be in place as we make the investment, but we should be comfortable that can come into play as you go through to launch. And then really we're looking for companies that we can help commercialize in 12 months. That's what we set ourselves as a target, and we do very, very well. Over 80% of our companies hit revenues within 12 months of us investing. Yeah, and if they're medical, fair enough. It's kind of sort of research revenues, but either way, we really sort of drill into them, the importance of some of those metrics. Get your IP filed, get some revenues in, let's get manufacturing set up, and then we can help you sort of with a follow-on round at a sort of healthy uptick.
Are there any red flags?
Yeah. So red flags, I say single founder. I know, happy to talk about it. Single founder. I don't think there's too many sort of absolute no-goes, but red flags in terms of we need to keep an eye on this one. So single founder for sure. So what we do is we do site visits. So if someone comes through and pitches to us, they get to that process and we can see we will know they're a single founder. It's quite hard in a pitch environment. It's quite difficult to really sense how they operate within a team. They may have brought their sort of CTO or something, but it's quite hard, right? Everyone's on best behavior when they're pitching. So what we do after they pitch, we'll do a commercial review, and then if that's successful, we go and do a site visit, and that's quite useful. It's part of that exercise lets us kind of, sometimes see the hardware if it's too big to bring into our on the pitch day, but also you can kind of see the dynamic within the team. So if it is a single founder, where's the commercial lead or where's the technical lead? How are they interacting and working together? And you can ask follow-up questions from the pitch day, sort of putting them under a little bit of pressure, but you just see how they deal with this stuff. So we do that for the single founder. That's something we've introduced this year on the back of us learning the hard way that single founding businesses are sometimes take a lot more work than when there's two or three. Absolutely. Well, yeah, I suppose one that's probably harder to get over, actually, if you've got another business, that probably is a no-go for us.
Just because they can't commit the time.
It's really tough. And I think we've probably done in the early days. We invested in one or two, and they had other businesses maybe that were really synergistic. So it kind of, you almost could look at it and go, that's a positive. It's within this sector. Like they're domain experts. They've been in the game a while. The reality is when the going gets tough on the startup, which it inevitably will, you kind of your instinct is to go back to that safe place, which is probably the business you've already set up. That's probably paying the bulk of your salary. So it's a bit of a conflict. So I always say to look, it's and we don't want to put people into a situation where they feel they have to exit some successful business they already have, would you say, look, it's not for us. What we're looking for is, we want to cover your salaries. We want to have you fully committed to the business. We don't want to. We're not sort of placing a bet and then you having another sort of option to move back to an old company. So yeah, so that's probably the biggest red flag, to be honest.
And so what do you look for, like in hardware products themselves?
They've got to have a positive impact on the people or planet. So that's where a lot of our medical comes from. And then the planet, it's not just around it's not just around impact businesses. But there should be a strong sense of purpose to every business. And on top of the other criteria that I mentioned, obviously that it's hardware, it's got IP, it's 12 months out from market, is that purpose piece is really,
and
really
is that
important.
purpose more of like a values driven thing from BDF, or is it more of you just think actually they're more likely to succeed because they have a clear purpose?
Yeah, to be honest, yeah, it is. It makes commercial sense, but I'm always kind of careful when I talk about this because, I would describe. You could crudely separate businesses into two camps, right? You could say you're either a vitamin business or a painkiller business.
Right.
And I say, well, we like painkiller businesses, right? But obviously, if I was an investor into consumer brands, I'd probably be investing largely into painkiller business, into vitamin businesses. Like nice to have businesses, but but the skill set you need as an investor there is really knowing how to market those things and convince consumers. Whereas with ours, we don't have to worry so much about that because it's
a clear need.
Yeah, exactly. And during the and they're largely B2B. So during the due diligence process, we will talk to we'll be looking in the commercial review and saying, okay, so in month 9, I can see there's a number. That's nice. There's a number in month 9 of your revenues. Like, give me some names. Like, who do you think that could be? And they'll list out some, and we'll talk to them during due diligence. So we don't have to. Obviously, every business needs to market, but it's rare that we get really caught up in kind of digital marketing strategies and kind of ROAS and stuff like that. I mean, every business does some of it, but if we were investing more in vitamin businesses, I'd say, where you have to convince the consumer of the need, you have to be an expert in that space, and that's not necessarily our forte. We don't pretend to be great at that.
Yeah, really interesting. We touched on IP. So how important is it that they've kind of got a defendable IP position?
So when we invest, we don't expect them to have that. That's where you guys come in, which is very helpful through our due diligence process, is we have to be comfortable, and there's obviously no guarantees in this game, but we have to have a strong degree of confidence that there is a patent coming through that can be put in place and defended, and we don't, and often the natural challenge, and I'm sure you hear this all the time as an IP firm as well, we often get pushback from companies saying, well, we're not going to be able to afford to defend it, are we? Of course, why do you make such a big thing about patents? We do. It's our fund. We've chosen to make that a big thing, and it's very important to us. But also, it's a deterrent, right? I always think if you've got a patent, you've got a good patent portfolio coming together. If someone opportunistic player comes along and they just poke their head over the wall, take a look, and go, "Ooh, actually, they've got quite a few patents there." Maybe the idea, that half-baked idea, never makes it any further. They just go on as a softer target, and that's.
I love that because that's exactly how I see IP, right? You can never have a cast iron guarantee that someone's not going to infringe your IP, right? But it's about reducing the risk, and it's sort of influencing third-party decision-making, right? So your competitor sees what you've got and thinks, are we going to launch a competing product? Actually, they've got some IP. It's going to be quite difficult. Let's not bother. Let's do something else.
It's like putting a burglar alarm on your house, right? If they really, really want to get into your house, they probably can somehow.
Yeah.
But they might just look at the house next door and go, they don't have one.
Yeah. So with businesses that you invest in, how long do they typically stay with you? And then what happens next once they've sort of burned through the cash that they've got from you?
So we look for 18-month cash runway as a minimum when we invest. We obviously know, and we put risk into the numbers when we're doing our commercial reviews. So we know that their forecasts will have probably overstated revenues and understated costs. It's fine. They're passionate, enthusiastic entrepreneurs. We wouldn't expect any less. But that's part of the reason we really focus on like tangible metrics that really, really move the needle on valuation, help them raise follow-on, like make them an attractive proposition for a follow-on funder. Because what you sometimes find, founders will come in, they'll do a pre-seed round or whatever you want to call our kind of tickets, right? Pre-seed round, and they're already becoming fixated by the seed and Series A, and that's kind of that to them is their, if they're drawing a timeline, that's another dot on the timeline. That's a really important milestone. So obviously it's an important part of your journey. But we sort of say, look, don't obsess about that. Don't obsess about the round. Obsess about what makes you attractive to that investor, that next investor, and also make sure the price is right. That's why our sweet spot is kind of £2 to £4 million valuations when we go in. So we know if we can get them from a pre-revenue business without any IP filed, without manufacturing set up, if we can tick those three things, get them in the market, maybe not market fit, but get them some revenues, get IP filed, get manufacturing set up, and we've gone at a sensible price already, we will be able to find them that follow-on funding, because we as a fund don't do follow-on funding, but we will be able to find them because they are an attractive proposition. They're sensibly priced. It can be a little bit of an up round. It doesn't need to be too much, but it's kind of, they've made some really, really, they've hit some tangible metrics. So that's kind of, and then we typically stay with, we coach these businesses until we exit our position. We aim for around 6 years is really what we aim for, and it may be a secondaries exit. So we typically will become quite a small part of that cap table when they hit sort of Series B. That's fine. We can, we've made our 10 times money. We can happily sort of step back and get taken out of the cap table at that point, or with hardware. I suppose there is a slightly unique element for acquisition in hardware, is that you typically have intermediaries as you go to market. Whereas you think a software business, there's also intermediaries for software, but very typically with hardware, if you think, take a medical device, accessing the US market, trying to access clinics, they're probably working with an intermediary, probably not going direct to all those clinics. And those intermediaries are, they're getting a slight discount on the ultimate trade price, but they're giving margin effectively. The way they see it is they're giving margin to the IP owner, and their competitors can also buy from that IP owner. So it's often an acquisition path will be that those intermediaries will acquire them as well, which is maybe a bit unique to hardware.
One of the things we touched on about when you're looking to invest in companies and how they're very much B2B, and do you ever look for sort of letters of intent, or are they kind of too early for that?
No, it's kind of very, very common.
Yeah.
And a letter of intent doesn't, different levels of formality, right?
Yeah.
But ultimately, we will talk to a customer. We will talk to a potential customer. We'll be very, very sensitive about it.
Yeah.
We understand you're probably, they probably have given you they will have given you a letter of intent or an email of intent or an indication of intent, because we do need that. But we recognise that, they probably still haven't absolutely made a decision. They may be waiting for you to get to TRL 8 or 9 before they can confirm it with a PO and all the rest of it. So we treat it very sensitively. But yeah, so we need to see that indication from market is important. But we're very careful how we talk to the potential customers and the sort of questions that we'll ask that customer. We won't necessarily dive too much into pricing because we recognise that's kind of a negotiation point. But we'll broadly define that market and say, okay, they're sort of playing in this kind of price range. That's what that appears to be of interest to you because you've given a letter of intent. But the sort of things we'll ask the potential customer is we'll say, look, why these guys and not someone else in the market, or what is it that they've done? And that's quite useful for us because we'll have technical experts contribute to our DD. But often those clients, like if it's a filtration expert from a water utilities business, like they're probably the most knowledgeable person of that sector. So hearing them and documenting that through our DD process about why they absolutely want to see this technology get to TRL 9 so they can buy the product is really helpful for us. But yeah, it's an important part of our DD, and our investors like it.
Do you know that'd be really helpful from the IP perspective as well? Because then once you know where the commercial value lies, you can then work out, right, that's what we should be protecting.
Yeah, and always set framing it in the sense of there's obviously loads of stuff going on. We've seen these guys pitch decks, we've done our competitor research, but there's always stuff that you've missed. But like hearing the people that actually are making the purchase decisions that have said, no, you get this thing funded, you get it to TRL, we will buy X number of these. It's really interesting to let them sell it back to us as an investor. Yeah.
Amazing. Slightly different question. Are there any misconceptions either from startups themselves or from investors as to sort of what signifies investability or scalability?
Well, I suppose from a VC point of view, it's changed a bit. But unfortunately, it's probably fairly true. Is like a lot of VCs now do need revenues. There's not that many VCs that will tolerate pre-revenue stuff. So then you start looking at grants and angels and things like that. With BDF, that's not the case. We do actually prefer that, but I recognise a lot of founders out there that that are looking for funding. That is a bit of a reality of the market at the moment, and VCs do want to see some sort of usually up to sort of $1 million revenue. I think particularly within hardware, though. I mean, hardware's a tough space. So when people come and pitch to us, they have, in the early days of us having the fund, when the brand wasn't as well known, they would come to us and say, God, I wish I'd known about you guys a bit earlier, because, we would have not gone knocking around all the houses to sort of try and raise money from people that clearly only want to invest in software. And I think if you spoke to those founders and said, like, what do you think the kind of barriers are, or, kind of to scalability? I think they would probably say, look, it's because we've got hardware, it's because there's these sunk costs. You've got, most of the time there's some setup cost, there's some tooling cost, and they're quite substantial. There's a compliance cost. Some software businesses would have compliance as well. There's quite a lot of upfront sunk costs, right? That people will say, we think that makes us uninvestable. It's an impossible hill to climb. How do we get past it without tons of grant funding? So, and I sort of, it's a unique feature of a hardware startup, is that they do have some of these sunk costs, right? It's pretty hard to hit revenues without sinking a load of cash into something. But if you're doing it sensibly and commercially, I look at that and say, well, it's kind of, we're here talking about IP as well, right? It's another moat. It's another reason that someone's not going to probably come up with this idea and become a competitor from the spare bedroom at home at the parents' house. They're not going to overnight start this, because it is actually quite difficult. So yeah, there's a cash element to it, but it is that you are building defensibility here. So our businesses don't suffer very often from competitors just appearing overnight from nowhere. It does happen, but it's not so common. Whereas I think maybe with sort of some of the software plays, there's so few barriers to getting a sort of MVP that you get competitors popping up constantly and appearing. So we don't get that
especially
so
with
much.
vibe coding and all of that these days. Yeah. So Damon, in your experience, what is one of the most common mistakes that startups, and in particular, hardware-based startups, make?
Running out of cash.
That was easy.
Yeah. I mean, that does kill it very quickly. So yeah, look, running out of cash. Obviously, that's why all businesses fail.
Yeah.
If you can keep raising, great, but then you've got to be careful about like what you're doing to your cap table and how you're diluting yourself. But yeah, I think kind of again, if you don't have advisors around you to help you see those things, I think just assuming that your revenues are going to come in, just assuming that you're going to basically come anywhere near what you forecasted is probably quite a big mistake, because it's not really going to happen. We know that. We did some analysis. It's too depressing to share on this podcast, but we did like an analysis of all of the forecasts at the point of us doing DD. Did an analysis of all the revenues and profit forecasts, for the first few years, and how many of them hit it. I mean, it was like I'm not even sure if it made 1%.
Wow.
Okay. But it doesn't. But the thing is, that's fine. We all know once the starting gun fires, the plan, everything changes, and it's firefighting mode, and you're just getting it through. And but I think, but a mistake founders can have is not kind of taking that kind of, I guess, the cash forecasting, some of the stuff that they probably look at and go, that's a little bit boring. I didn't get out of bed to produce management information and cash flows and things like that. But actually, they are so important, because it gives you that little bit of extra window, because we can possibly solve a cash flow problem that's 6 months out. But like 6 weeks, like if you actually come to me and say, we can't hit payroll end of next month, that doesn't give us a huge amount of time.
No, it's a bit tight.
Yeah. So I think sometimes investors that they raise their funds, and they've done all of the modeling, obviously, to raise the money, and it looks very impressive. And then they just discard that governance, and they just crack on and focus on the tech, try and get some sales. And the thing is, they genuinely will be trying their best. They'll be talking to customers, they're trying to get business in. But if they really sort of discount the importance of that governance and management information, you can run into some sort of pretty nasty traps that are hard to get out of, and you're suddenly having to dismiss half your team and go into sort of dormant mode until you can find funding. It's not a great place to be. So yeah, yeah, importance of cash flow and cash for sure.
Yeah, heard loud and clear. Damon, it's been amazing talking to you. The time has absolutely flown by. I think before we finish, I thought it'd be nice just to have sort of an answer to one more question from you, if that's all right. And this is sort of based on your experience, investing in the ecosystem, your own experience yourself. What advice would you give a founder or a founder team looking to launch and start a hardware-based company in the UK today?
Okay, so I don't think it matters about the fact it's hardware. I think like, and it's easy for me to say in this position, but I think the hardest thing about starting companies is actually like identifying a problem that really, really needs to be solved, that people are willing to pay the price for.
That you need that painkiller for.
Yeah, like, honestly, it sounds so easy to say it, but it is the hardest thing. We see so many times this phenomenal tech, and it's looking for a home. Like, it doesn't really have it doesn't know what it's solving, but it's very clever.
Yeah.
But it doesn't know what it's solving. But if you start the other way and say, look, what is this problem? Do people really care about it? Is the market big enough as well? Because sometimes there's very important things that just there's not a big enough market, so VCs can't get involved. But a really important problem that absolutely should be solved, and your solution is able to be made at a price that people are willing to pay for it. If you can do that, and it sounds very easy when I summarize it like that, but I'd say that's the hardest bit.
Amazing. Damon, thank you so much.
Thank you.